Welcome, everyone, to another episode of Wolf Street. For those of you that don't know, my name is Wolf, and for those of you that do, thanks for checking me out again. As always, this video is intended for educational and informational purposes only. It's not financial advice. If you need that, please contact somebody. Please don't call Tom Brady for financial advice. Let's start there. And if anybody is involved in FTX, don't talk to them either. So that's where we're going to start right off the cuff. Once again, this is not intended for financial advice. If you need financial advice, please check out a financial advisor. There's plenty of good ones, and work out a plan that would work best for you. Now is not the time to be messing around, right? Now is not the time trying to figure stuff out on the fly, listening to some dude on the internet. Get your shit together. If you're not divorced yet and you're doing that, you will be soon. Get fucked, J-Rod. And yeah, let's just jump right into it. If you don't know why there's a banana on your screen, right? So if you're not listening to this and you're watching this, you'll see a banana on the screen. If you are just listening to it, it's a red background with a banana. And if you don't know why there is a banana on the screen, I'm just going to jump right to the next slide so we can just get really juicy with it. First and foremost, I told all of you fucking crypto nerds, this is how it's going to end. I told you. I listened to your shit for 17 months about how this time's fucking different. I wouldn't understand, despite the fact that I probably made more than you have. Most of you. Obviously, I'm a small fish compared to some of you. Size is not size, people. But in general, I told most of you idiots, this is how it's going to end. And I say that affectionately and lovingly. Hopefully the lashings aren't too bad and you'll make it through it. But I have the banana on the screen. Let's go back. Let's look at the banana again. I have the banana on the screen because it is comedic gold. Just like there was a banana on a wall at Art Basel, I think like 6 years ago, and it sold for God knows how much. This is a perfect metaphor for everything that's going on right now. And I couldn't make this shit up. You couldn't make this shit up. If we got paid to write a comedy skit about how this stuff's going to end, we wouldn't have come up with this stuff, right? So let's go to this real quick. So this is allegedly, so I'm going to throw that allegedly word out there. This is allegedly how a conversation went down between Sequoia and FTX. So, quote, that's when SBF, so SBF, you don't know, SBF, let's just jump to the next slide real quick so I can introduce you. It's this beautiful gentleman here who didn't know what a Ponzi scheme was when he was describing crypto and described crypto as a Ponzi scheme. He was just a month and a half ago, I think, on the cover of Fortune magazine as the next Warren Buffett. Whoops. That didn't work out too well. But anyways, he's in on crypto because he wants to make the biggest global impact for good. Well, you just gave a lot of people a lot of money by costing people who don't want to lose money. It's weird. But anyways, let's go back. So that brilliant guy told Sequoia about the so-called super app. And it ties so beautifully in with what is going on today. I can't make this shit up. You can't make this shit up. And it just fucking happened out to work this way. So the power of the Matrix. I want FTX to be a place where you can do anything you want with your next dollar. You could buy Bitcoin. You can send money in whatever currency to any friend anywhere in the world. You can buy a banana. You can do anything you want with your money from inside FTX. And so it says, suddenly the chat window on Sequoia's side of the Zoom lights up with partners freaking out. I love this founder. 10 of 10. Yes. What Sequoia was reacting to was the scale of SBF's vision. So everybody's talking about scale. And the person who quotes this says, I sit 10 feet from him. And I walk over there thinking, oh shit, that was really good. And it turns out that fucker was playing League of Legends through the entire meeting. This dude was conning y'all while playing video games. If that does not describe to you like how crazy the last 2 years have been, I don't think anything will. And I'm starting spicy and I'm starting there because, and I've already shared the slide, but it wrapped up with some of the biggest fucking celebrities on the planet. right? So right off the cuff, I'm going to tell you something. If you meet somebody who says that they're a vegan and they're out of shape, question their character. If that gets me canceled, so fucking be it. Could we think of a more cherry on top way that Tom Brady's year from hell, and I use that word, year from hell, I use that, in parentheses, Tom Brady's got a better life than I do, right? He's got a better life than most of us. So let's just put that with a giant asterisk. Could we have bookmarked that kind of year more crazily than getting wrapped up in an FTX exchange that ends up, FTX, a crypto exchange that ends up insolvent, right? In 3 days, SBF's net worth goes from 16 billion to bankruptcy. Like you could not have scripted that in a crazier, more appropriate way, that Brady's whole life kind of like dissolves in front of his eyes, and they basically top ticked the worst crypto investment you could have right now, with their partnerships, right? And I'm not here to pour salt on the wound for guys like that. I'm here to pour salt on the wound for guys like SBF, right? Because allegedly, and I'm using allegedly here, he's ripping people off, misappropriating their funds while lying to Congress. Hey man, to quote Martin Shkreli, prison's not that bad. And if we just go back to this letter that he put out, this Zoom call that took place, right? I want people to buy a banana, and you can send money in whatever currency to any friend in the world. Like, why am I harping on this, right? And I think it just ties in perfectly with today's story. Good old Elon. Good old Elon was on a Twitter space today for about 45 minutes to an hour. At least that's what I saw. And, it was kind of vintage Elon, off the cuff, kind of addressing some things. Maybe I can work my magic. Maybe I can kind of guide things to go the way that I want the Matrix to go. And among other things, he described the why for the check marks and why they decided to go the routes that they went. He decided to explain to people that, he believes that if you incentivize people to pay $8 a month, that you're not going to have spam bots, right? That's what he said. And so right off the bat, what do you know? Debunked. He also said that it would create some credibility with advertisers. And there were a lot of advertisers in the space. There was Jordan Brand, Nike, etc. They're all listening. As I think, I stopped looking, but at one point it was like 40,000 people or something like that in the space. I don't know how many were in there. I stopped looking at the counter, but like right off the bat, there you go. There's your check marks. Doesn't work. And who knows? Maybe this is the internet playing a trick on me. So I'll say that on the front end. And then, hey, I wonder why advertisers are fleeing. And so right off the bat, Elon being Elon, two things he mentioned right off the cuff, probably not true. He also says that, or not him, his, what is the guy's name? Yoel? I don't know how to say his name, but that basically the commentary around racism and inappropriate action on the platform is down, not up, all-time low. They're screening it. It was just vintage Elon. But the main reason that I want to tie Elon in this story is at some point in his conversation, Elon does the Silicon Valley SBF playbook, where he says basically he wants people to stay on the app and he wants people to be able to do transactions on the app, and at some point they can give people a yield and a money market on the app. Basically says it's the same playbook. It's the same playbook. Essentially, he should have just said you can buy a fucking banana on Twitter. It's essentially the same thing. It's the same playbook. And it just tells me, I lived in this industry for about 7 to 10 years. depending on what you count, right? It's the same playbook, man. Get as many users as possible, get them to commit to something, get a recurring revenue base out of it, and then build as much shit on top of it as possible. Everybody wants to be Apple. Everybody wants to be Amazon. Everybody wants to be Google. Layers upon layers upon layers of an ecosystem, Microsoft as well, where you can just bill people over and over again. And sure, hey, you know what? Maybe I'm wrong. Maybe Elon's right. Maybe this will work out. But sure shit ain't going to work out if you're cutting costs. Got to raise costs at some point, right? So I think in the middle of all this, it seemed almost poetic that he kind of like turned on the selling algo for Tesla while he went up there and started pumping the next FTX. It seemed very apropos for where we're at right now. But I will say that people are paying for the check marks. And with that, I think that, hey, Linda, you paying $8 a month doesn't mean that what you're saying has relevance. So I'm going to say that right now. See a lot of people with newly minted check marks thinking that it gives them some sort of authority on some sort of topic. It doesn't. And this is the endemic problem with these check marks. It's the endemic problem with social media in general. Now, I applaud people. Maybe Elon is genuinely trying to fix it, so I applaud him for trying to genuinely fix it, but that's not how you fix it. And so it becomes a circular argument. We can have another day, right? So I think this 10, 12 minutes, whatever it is that I'm at right now, diatribe monologue is a really good, fresh intro for what it is that we all should and want to talk about, right? We got our 75 basis points last week. You saw this slide last week. Got our 75 basis points. Now what, right? So here's your, or in my case, my trusty levels chart, right? Here's your 20-day on the NASDAQ, 11,131. 50-day, 11,459. 100-day, basically 12. 200-day, basically 12,75. And then here's your Qs, SPX, SPY, here's your Dow, here's your resistance and support, right? You want to screenshot this, screenshot it, do whatever you want, but there it is. Now we go back over to ES. Essentially on ES, we're just in a wedge, right? It's this painful looking for a resolution ahead of some sort of economic thing. What could it be? What could we all be waiting for? Oh shit, yeah, it's the CPI tomorrow, right? And in general, for what the expectations are on CPI, on average, you have a consensus expectation for 7.9%. I believe if you look at the Cleveland Fed, which everyone for some reason has used that one, I guess they're more aggressive. I don't necessarily know why, but everyone's kind of talking about the Cleveland Fed. I believe it's 8.2, and people generally are deferring that it could be a little bit more hawkish on the back of it. You got Morgan Stanley looking for 8%, Wells Fargo 8%, Goldman Sachs 7.9, Credit Suisse 7.8, Barclays 7.8, Jefferies 7.9, Bank of America 7.8, BMO 8%. So essentially, you got 7.9 in the cards. That's the expectation. You have a 0.6%, expectation not on the annual side. The last number was 0.4%. Again, these giant prints, the giant print number that they talk about, this 8% number is not. It's a year-over-year number, right? So it's not the quarter-on-quarter or month-on-month or something like that, right? So essentially, what does this all mean, right? Like everybody going into last week, and I'm using everybody generously here, was excited for a possible pivot. Powell's going to pivot, the Fed's going to pivot, everybody's going to pivot. We're going to have a pivot party, right? That was the expectation. Now, I don't need to remind you, you've watched enough of me and heard enough of me to see some of these slides come up over and over again. But essentially, Powell's basically doing his damnedest to tell you he's not fucking pivoting. And I'm going to take him at his word. He's not going to pivot, right? I'm going to take him at his word because generally these guys don't pivot until they break something. So with that, the thesis stays the same. Over time, market correlates with the direction of earnings, and earnings are expected to drop. EPS is driven by the direction of the economic activity. We're probably going into a recession. Can we call it a recession? We're changing definitions every other day, but can we call it a recession? I think we can call it a recession. Economic activity is produced by money availability. You get your money by selling stuff, by working, by borrowing, and by taking out equity in your home. You can't do the equity thing because rates are so high. The average person has a mortgage below 4%. Can't do the stock thing because stocks are down. Can't borrow against your portfolio because your portfolio is down. And in general, more and more people are, or let me say it the other way, less and less people have access to capital because less and less people have qualifications to get the capital. Banks have tighter lending standards for starters, right? And so, this goes back to money availability is driven by Fed policy, right? And the Fed's telling you, I'm going to be Volcker. We can argue about whether or not that's a positive, what they should do, shouldn't do, whatever, but they're telling you what they're going to do. And until that changes, got to take them at their word. Because you can lose your shirt and become like SBF real quick by not. And so Fed policy is driven by inflation and employment. We have the playbook in front of us. They tell you they want a 2% interest rate. They want a 2% inflation rate. They want the labor market to be in more of a balance, and labor force participation rate to be strong. And in general, you have high inflation, right? You've got an expectation of 8% year on year, and you've got a very strong jobs market. And in those instances, it sets up for them to raise rates. On the back of raising rates, we can argue about how far they should go, right? Like you can argue they shouldn't be Volcker. I'll touch on that in a second. But when they do raise rates, money availability comes in. And then on the back of that, economic activity comes in. And on the back of that, EPS comes in. And on the back of that, the market comes in, right? So it's just a very simple feedback loop. Fed raises rates, less money available, less money comes out, goes out to companies, less money goes out to companies, less the EPS gets, lower the market goes, right? So very quickly, this was from the last video, and basically we kind of talked about how, expectations now are for 5% by the middle of the year, and then whether or not they cool will be the question. So if the Fed doesn't reverse course, by the middle of the year, you could have real problems because the expected recession could be worse. That's just a simple way of putting it. And this is a nice little smoothed out version for how you can see it, right? And, we talked about in the last video that historically, after you have a 20% sell-off in the first 3 quarters, generally speaking, you have a fourth quarter performance outside of 2008 where you have a rally, right? So we talked about this. Now, what I also talked about was the mechanism by which you get to that rally and how you get to that number. Like, again, if we go back, let me see, where is this? If I go back to the slide that I was just on, and we talk about how, you can have a sell-off of 23%, right? We talked about this last time, that how you get to that 23%, like numbers on a screen don't tell you the story. So this was the 23%. You had a 22% rally into the end of the year anyways. So again, on average, I think today we were at, we were up 6% or something like that going into today still. So on average, you're getting a median of 7.9% return and an average of 3.5%. Basically tells you you're kind of capped. Doesn't tell me too much, right? And so, generally speaking, could we sell off on the back of a hotter than expected CPI or on the back of whatever contagions happening in the crypto market? Yeah, sure. And then on the back of that sell-off, could we rally back to get to this average number or this median number? Yeah, sure. But the point still stands that we're in a situation where we're very data dependent. We're depending on a bunch of different variables that may or may not have anything to do with each other. And we're depending on, now this crypto volatility and how it has impacts into the market. And on the back of it, we're depending on a Fed that may or may not pivot. So everybody wants to talk about a pivot, and everybody wants to say, hey, pivot's coming. But generally speaking, a pivot's not where you buy. Generally speaking, a pivot means something broke and they're trying to fix it, right? So if you just go back, especially in a highly leveraged system like the one that we're in, if you go back to 07, they pivoted, fell off a cliff. They did an emergency cut here too, right? So where's that slide from 08? They ended up doing an emergency cut, right? Right here. Still sold off. So generally speaking, when you have a pivot, it doesn't mean that that's the bottom. Now, I've argued that the pivot's going to be in language first, and they're going to try to weasel their way out of it. And I don't think it'll work, but that's my opinion. I think at some point the pivot comes in the rhetoric. The pivot comes as, hey, we were looking for 2%. That's not realistic, so we're going to go 4% or 3%, or hey, we got a new system, or whatever the case may be, and try to wiggle some nuance around it. That's my opinion. Could be wrong. It's my opinion right now, though. But I want to touch on a couple of things. So, first, Powell spoke on this in the middle of his presser last time, and essentially he says that, kind of batted at the market, saying that he was not thrilled with the short-term inflation expectations on the back of the rise in break-evens for the 2-year. So Powell basically was saying to the market, hey, we're going to do whatever we got to do. And that's kind of like the come to Jesus moment that we had from the market on the back of what it was that he was saying. If you remember, there was like a push-pull, and there was like a couple people, shout out Jeremy in particular, I remember him saying, why would they say something soft and then come out and be aggressive in tone? And essentially it's like so that they don't trip the circuit breakers. You don't come in, you either come in heavy-handed and then you walk them back, or you come in nuanced and then you kind of hammer them home. That's kind of been their MO. Not sure why that is in general. Outside of just the optics of it, I'm not sure why. But if you're trying to say that you're the next Volcker, why should you care, right? We could have that argument another time. But essentially, he wasn't happy, and he was trying to bat that down. And the other thing that he did was he kind of, highlighted the PCE and kind of brought that back into focus. So tomorrow's a CPI, but in general, their favorite tool is the PCE. And for a while, that kind of shifted and the narrative kind of got away from them. And he tried to rein it in the last time. But it's still high, right? So they keep telling us their longer-term expectations at 2%. And I keep arguing, what if it gets to like 3, and then you have if it gets to like 3.25, and you have, some structural stuff that won't bring it back down to 2%. Then what are they going to do? You can't, because at the end of the day, we talked about this last time, we can't keep looking at this stuff like, it's an econ PhD level course, right? At the end of the day, these numbers represent people. They represent goods. They represent services. And it's very easy to be tough and try to be tough when, people's livelihoods are not completely in shambles. Once things kind of hit the fan, then it comes a little bit more difficult. You got to have a little bit more nuance. So that becomes the question. Is that going to be how they're going to handle it? Or is that are they going to stay with this draconian, like Volcker-esque wannabe style that they've been on? And I'm not sure what the answer is. I would hope that they would be, as aggressive as they need to be, and then kind of be nuanced. And that's kind of what the market picked up early in the last meeting, where they said that they would pause if they need to. That's kind of why they started to run things before he spoke. But I don't know necessarily if that's how it's going to play out. I do think that generally people make mistakes, and the more mistakes that they make, they become more inclined to make more mistakes, right? You got a 50-50 probability that you did the right thing the first time. The more and more variables that you throw at it, the less and less the probability becomes, because you got to be correct on multiple things. And so it becomes a basic math problem. We talked about this last time as well. The top 10 stocks represent, I think, now 25% of all S&P market cap, and we're seeing that in general, right? So we see, this week alone, we've seen advanced decline line kind of be elevated for a couple of days, and then you look and the market's like stuck in some sort of range, and essentially that's because the darlings are getting smoked, and you get, Amazon making new lows today. You get Tesla getting obliterated. You get Apple kind of coming in, Microsoft coming in. You get all these names that have been darlings for so long coming in that when the Amgens of the world, the Gileads of the world, the Exxons of the world run, it doesn't really offset like people expect. And so it's important to kind of remember that, and important to kind of think of, where you are in context. And if we just kind of highlight where we are in context, we're really just in this wedge. And could we rally tomorrow on a softer than expected CPI? You bet your ass we could. And one of the reasons that we could is this is hedging. This is put to call ratio. There was a question about whether or not this was, true put to call, or whether it was risk adjusted, or whether it was cash adjusted. I'm not a hedge fund manager. Couldn't tell you. It's possible. But still, you get this equity put to call ratio spike, highest since 2008, and it goes above, this put to call ratio from 2020. That results in one of two ways, in my opinion. It either results in a feedback loop lower if things are too hot or they're bad, or it results in a lot of this needing to get worked off. And with as much cash on the sidelines as there is, you could get a rally, right? And so kind of have to be, nimble with what it is that actually happens, and kind of set the stage for what it is that could push it higher or push it lower. And, one of the problems that and this is where I started, one of the problems is a lot of these assets that people were telling you were non-corollary are showing you that they are very, very correlated, right? And so if you just take a look at Bitcoin, for example, this is a trend from 2013, got smoked this week. This is not the end, right? Generally speaking, when trends like this break, it's not the end. It's generally the beginning of something. And so then it becomes how much collateral damage comes on the back of something like this, right? So if we just right off the bat, you just correlate it. Look at ARK. ARK made its low today. It's not like a random thing that could have happened, right? It's not just, oh my God, I can't believe ARK just decided today, this week, to make a new low. No, these assets are kind of correlated. A lot of people who own ARK own Bitcoin, and vice versa. And it's not just Bitcoin, so I'm not going to pick on it. Like, just look at Ethereum, right? Like, a lot of these, I had such a good chart on this one earlier. I deleted it. A lot of these, but it was like this, basically. A lot of these cryptos that people own, they move in tandem with a lot of their favorite junky risk assets, and vice versa. There's no bigger poster boy for that than Tesla. And so let me just remove drawings. And this 180 level that Tesla has been holding since November 2020 got smoked today. And this 200 simple moving average, which hasn't been cracked since Tesla broke out in October of 2019, broke today. And it opens the door for this, 200 simple moving average at like 160. If it gets there in the next couple of days, that's where it will be. But it opens the door for these things to get tested. Now, along the way, these drops and these return to means happen, and they're violent, and you can trade them, right? So we could see a gap. I mentioned this in the Discord earlier. You can see, I also tweeted it, you can see a drop down to, that 165-ish level, which is where it broke out from in November of 2020. Or you can see it become more aggressive and come back down to like that 160 level. If we just do it on the technical side, you can see it go to 160, right? Which goes in line with that 200 SMA. Or, yeah. So, you're starting to see some of these dislocations, and we're starting to see some of these things kind of play out that way. And essentially, I don't want to, let me just go to daily. So there's essentially, I don't want to get in front of it, right? I could be wrong, and I could see, rallies, and I could see things come back. But generally, like, this is a stock in a downward momentum. It's a stock who currently does not have a CEO because the CEO is too busy telling you about how he's going to make the next FTX of the future. And go back to the banana. And, where they find a floor is your guess. It's anybody's guess, really. We can assume that the 200 week is going to be one of the major things that holds, but who knows? Go back to Apple, another one, right? It's on trend. It's on trend, literally on trend. So, if it follows through and it breaks down, you're looking at 130. And the problem with things like this is they become feedback loops, right? So, crypto peg got knocked. Now you're having these momentum leaders get knocked down as well. What carries it? The names that have been performing. So you just take a look like Gilead, for example. This one's been performing. This one's topping out on a short-term basis, but like it's been performing, right? I guarantee you your favorite 22-year-old Finbro who's been telling you to buy Dogecoin and Cumcoin for the last 2 years plus isn't going to be the guy that tells you to turn around and buy Gilead right now, right? If they are, it's probably going to be extended, right? Trends have been broken. There's no leadership, and the leadership that has existed or persisted isn't big enough to offset some of these losses that we see in some of these Apples, some of these Googles, some of these Microsoft, another one, Amazon, right? They're not big enough. And so until we have either a violent sell that just kind of you get this capitulation event where, you trade 2-3 times volume or 1.5 times volume at least, and then it hits a low and reverses, or you gap down so hard and you finish the day on above average volume, something changes and it reverses higher. We have all this room for these back and fills back and forth, right? Again, if I just go to this 2008 pain, let me find it. If I just go to this 2008 pain, these are violent moves, right? This is a 22% move, and this is probably a 30% move. And so when you think of things like that, it kind of puts things in perspective. It tells you not to get ahead of things, not to jump the gun, not to be overly excited, right? And so tomorrow we get the CPI. Again, expectations for around 8%. If it comes in hot, you're going to set we're setting things up to potentially retest the lows, right? And so could see 3640, give or take, on the S&P very, very quickly. And then the inverse is true. If it comes in soft or like significantly softer, there's enough cash on the sidelines, it's going to flush things higher, significantly higher in a short-term basis. Now, the point becomes when you see these rips happen, if there's names that you have wanted to trade or want to be in or want to move around, go for it, but don't fall in love, right? Essentially, when we get to one of two things, when we get to either around 10% of stocks trading above their 10-day moving average, or around 90% of stocks trading, call it 80% of stocks trading above their 10-day moving average, generally we'll get to an extreme in sentiment. And in those instances, we reevaluate where we are and we could be aggressive. So it's a lot of like just sitting around and waiting, and it sucks, right? I swear it sucks. I'm with you, right? Like I traded Google. I happened to catch the bottom. I barely got 50-some%. It's boring. It sucks. But it saves me from losing my shirt, right? Simultaneously, I thought I had a breakout in Deer. I didn't. I lost money. Not much, but I lost money. And I'm out. Now, tomorrow, for all I freaking know, I could see this opening above 410 and making me look like an idiot. But generally, I'm not losing. I'm staying within a range, and I'm staying within myself, not losing, sizable amounts of money. Because in an environment like this where you don't have leadership, if I just go back just use Tesla for example. Before this thing started to really sell off, you had this, right? And a good corollary for this, just look at Nope, right? That back and forth in Tesla knocked this guy down from his let's say his what is this, $21. So knocked him down from $21 to 15, right? You either have to be financially irresponsible enough to go through stuff like this, or you be, the opposite. And in that case, hold on, and in that case, he sits through this, and we're right back to where it's not like he's up, right? It's not like he's significantly up. Like I'm not sitting through that kind of volatility, and then on the back of Tesla selling off, 14%, I'm break even. I'm not sitting through that. That's not anything I want to do, right? Like I would much rather take my little losses and keep it moving, and then one of these times I'm going to hit it. And so that's kind of like the perspective that I think we have to have, and what the perspective that we should have continuing to move forward. Now, on top of all this, on Friday we have the University of Michigan Consumer Sentiment at 10 a.m. Now, the expectations for 59. The previous number was 59.9. If you get a significant drop in consumer sentiment because the consumer's pinched, then again, we have the same thing, right? Like we're moving day to day, headline to headline, situation to situation. It's all fluid, and we need to be coherent, and we need to not panic one way or the other. And when we get these extremes, we're going to get volatility whooshes up and down. And when we get these extremes to the downside, for example, like here's your NASDAQ, we're going to press up against that 10.7 level potentially. And when we get these extremes, if it were to break this, and let's say it comes back and retests the low at 10.5, give or take, we reevaluate. If it breaks down even further and you get like a real sell-off, the next important level to watch is that 10,300 level. And in instances like that, this is a lot of backing and filling, right? So we go from 10.7 to 11.7. That's 10%. And then we give it all back. And then we go back up. We give it all back. And so there are opportunities, but until we have some sort of resolution or some sort of hint at a resolution, at a real resolution, we're going to have a lot of this stuff. We're going to have a lot of this back and forth. We're going to have a lot of this, right? You're going to have a lot of headline to headline to headline to headline. So it's very important to stay, within yourself, not get too aggressive one way or the other, not lean too bullish, not lean too bearish, and just kind of trade what's in front of you. And we're getting these 10% back and forth moves. Now, for me, I'm not comfortable with some of these moves, so I avoid some of them. But in general, these are moves that we're getting. And I find it just simpler to get a little bit more clarity. Now, remember, one thing that we're looking for is for bonds to roll over. And when we typically see bonds roll over, we want to see the market itself make a new low, and on the back of the new low, not have bonds reaccelerate, right? And so we've had a couple of analogs. The dollar was one of them, or a couple of correlations, right? The dollar is one of them. Started to break down this week. And we'll see if this was like a temporary setback or if it's like the setback. And then secondarily, on the back of that, we saw gold break out, right? And so gold broke this downtrend, but it stalled at its 100-day. If gold can consolidate and continue higher, the dollar comes in, this kind of sets up some sort of something that you can possibly hang your hat on, possibly look for to the upside. So that's kind of like where we're at. It's kind of where I've got my head at, right? And it's especially difficult to deploy real sizable money when you got Banana Boy, costing people billions of dollars. And then you got Musk wanting to be the next Banana Boy, and Tesla shares coming off daily. So that's it. Thank you for time. Thank you for dealing with my shit. Thank you to everybody that's watched this, even you, J-Rod. Despite you getting fucked, even you. And please stay safe, stay profitable, stay nimble, and stay locked in.